You're watching the Juice Consumer Direct Podcast. I'm Carson Poppinger here with Jacob Thorpe, and we have a special guest today, Mike Eshelman. Welcome, Mike.
Thank you for having me. I appreciate it.
Just to give a little bit of background on Mike and his background, Mike is a mortgage marketing veteran. He's got over 20 years of experience in the industry and over 2 decades performing mortgage marketing and managing over 150 million in campaign spend that he's handled and overseen. Mike has earned a certified mortgage banker designation from the MBA, Mortgage Bankers Association, and today advises lenders, mega brokers, fintechs, and lead generation firms with his consultancy Next Percent. He also is a co-founder of LockedIn Agency, where he delivers creative marketing, ad copy, and web design solutions tailored for mortgage companies. And so, Mike, it's great to have you here with us talking about, the state of the mortgage industry and get to know you a little bit more and chat about what's going on.
Yeah, I'm looking forward to it. We've known each other for quite some time, so I'm glad to finally have the opportunity to sit down, be on the show, and chat mortgage.
Yeah, I had somebody the other day ask me about Squatters Pub and downtown Salt Lake. And I was like, well, I went there with Mike. Mike was in town. You were with First Direct Lending. You came in for a visit. And I was like, hey, let's get together and have dinner. And I knew you were going to be downtown. So we just met up there and had dinner. And that was like back in the early days, probably over a decade ago. So anyway.
I was fresh at that point. I was starting to manage accounts, and I was trying to just like soak it all in at that point. I remember feeling very underqualified.
You came to dinner with us? Yeah.
I didn't come to dinner with you, but I managed that account.
Oh yeah.
I managed that account, so I was doing my best.
That's right, doing your best.
Earnest.
You did all right.
For sure.
Kept you around.
Yes, you did.
Yeah, that was fun. I was probably, because I'm based in Southern California, and we have the office in Salt Lake City, and I was probably going out there every other week or so to manage the Salt Lake City contact center office. We would send, pretty much all of the leads that we were generating to that contact center to then transfer into loan officers. And so, it was a good time.
Yeah, and you're in Southern California, and you guys have been affected a little bit by the fires. I remember when we were talking 6 months ago, you had, you were dealing with some of the fire right off your back patio, pretty much. Can you talk about that at all? What's been happening there?
Everyone's heard about the wildfires in Southern California, the Palisades fire, the Eaton fire in January. So before that, so in early November, was the day after the election, I was actually on site at a client in Orange County, which is 2 hours south of here, so 100 miles south of here. And I was
going to say 10 miles. So you mean 10 miles south of there?
Yeah, right.
Depends on the time of day, I guess.
I do leave at 5:15 in the morning to get there in a couple of hours. Exactly. But at any rate, I was giving a presentation to the executive team, how the quarter went, what Q4 looked like, and the 2025 budgeting plan. And all of a sudden, someone, the head of customer service, said, Mike, your father-in-law is trying to get a hold of you. And it's like, we're the CEOs, the CFO, like we're talking, it's a big firm. And my father-in-law is calling through the customer service lines. I look at my phone and I see text from my wife, fire, why aren't you answering? Because I had my phone near my laptop on the table in the conference room. I wasn't looking at it because I was giving a presentation. So, and needless to say, I bolted out of that room very quickly and started heading home. But it's called the Mountain Fire, and the Mountain Fire started a couple of miles just north of us, and winds were 80 mile per hour plus on that day. And we have a few acres, and it burned half of the property. Thankfully the house is still standing. We had a ton of smoke damage, and we couldn't live in our house for a couple of months, getting that taken care of and cleaned up. And right before we started recording, we were talking about allergies. We've been cutting down a bunch of trees over the last, week or so that are burned and not coming back. And so allergy has been crazy for us here because of that. But yeah, no, it's, I mean, look, it's the wildfires is a real issue out here in Southern California. And, as I think about how it ties into mortgage, there's my insurance carrier. I'm sure our insurance rates are going to jack up 30, 40, 50%. And, what does that do to our payment? We'll be fine. But as you think about housing affordability for other folks, housing affordability is already an issue. So
yeah, especially in that area, it's not easy to afford a home.
Yeah, sorry you went through all that. That's I mean, it's tough thinking about dealing with the, devastation as big as that, in addition to handling all your other responsibilities and keeping things going. It's hats off to you for all the hard work you've put in to protect your home and then rebuild. So.
Yeah. We're lucky. Our house is standing. We had to go through a couple of months cleaning, but there's others who. There's plenty of the neighborhood that did burn down. So it's going to be significantly more impactful for them as they try to rebuild over the next couple of years.
Mm-hmm.
But
yeah, I had some friends affected by the Palisades fire too. And, they're still dealing with that as well. So so sorry. So sorry for all of our friends down in Southern California. But nice to have you with us today, Mike. And
on that note,
let's jump into
to the mortgage industry. Right?
Like a phoenix from the ashes. Great to have you here. There's a lot going on in mortgage. I mean, you've been at the forefront of a lot of the changes that have happened over the last 10 years, 20 years, and seen a lot of change and anticipate a lot of change. Mm-hmm. And
you also have a lot of experience in both new customer acquisition and servicing. So you kind of sit in a unique spot where you see that full life cycle of a loan, from filling out a web form to collecting the payments, right? And that's a unique place to sit, because I think oftentimes in the industry you get people who are pretty siloed at what they do, and they stick in that niche. I'd love to hear, like, over the past 12 months, I feel like there's been a lot of false starts with the mortgage market, right? Hey, rates are going to drop. Oh, wait, no, they're not. Hey, the 10-year treasury just hit 4%. Is it going to drop below? No, actually, it's going to jump to 4.8. There's been a ton of volatility. So what are the changes that you've seen over the past, let's say, we could say a year. We could also say 6 months, I think.
Yeah, I mean, obviously it's been very volatile, for sure. There's a lot of uncertainty. I mean, we see a lot of that play out in the news, and as it relates to mortgage rates, it's been, you're right, a lot of false starts. I mean, we were all expecting that we were going to be cruising down into maybe the high fives by this point in time, and here we are, high sixes, and sometimes back up into the sevens. And I've seen in the news recently, and I've seen it with some clients, there's more aggressive recruiting of loan officers happening very recently. So it seems like, the larger companies, and they're seeing I'm hoping, right? They're seeing the writing on the wall that, hey, over the next several months, we will start to see an increase in mortgage production. I think when you're starting to see signing bonuses being pushed out there and more recruiting efforts being pushed out there to hire loan officers and bring them in and train them, that's a real sign that companies are putting their money where their mouth is and betting on that. So, hopefully we'll see that. I'd even stretch it back further though to say the last 24, maybe even 36 months, I've seen a lot of folks, a lot of loan officers, very talented loan officers, migrate over to the broker channel. And it's been a really interesting dynamic to see that. I think we see some, if you want to call them mega brokers, who are kind of mimicking that consumer direct model, but in the broker channel. And it's been paying off quite well. And so we've seen a lot of growth there, and I'm really interested to see that as mortgage rates drop, as the market starts to, quote unquote, come back. do we see those very talented, high producing loan officers stay in the broker channel, or do they go back to that call center consumer direct model? I think a lot of them are going to stay broker. But it's been a really interesting dynamic because, from the wholesale channel, the broker channel, the market share was down, I think 7 or 8% right after the financial crisis. Mm-hmm. And independent mortgage banks, for over a decade started dominating the landscape because traditional banks backed off a bit. But over the last 2-3 years, we've really seen a lot of investment in the wholesale channel. We've seen a lot more loan officers go to the broker wholesale channel. And so I'm really interested to see, if that continues and how much that continues over the next 3 and 5 years.
Could you maybe explain to our listeners what would motivate someone to move into the broker channel and the difference between kind of the two different models?
Yeah. Yeah. So, for the first 15, 16, 17 years of my career, it's been consumer direct, right? So I'm used to marketing to consumers who come in, and the vast majority of products are going to be your Fannie, Freddie, or, FHA, VA with Ginnie products, and 30-year fixed.
Yep.
Sometimes you get a 20-year, every once in a while you get a 15-year. But for the most part, you're selling 30-year fixed in, these very limited product sets. And when you look at it from a marketer's perspective, marketing cost per funded loan, if we just make up numbers and say, you're somewhere around $2,500 in marketing spend to get a funded loan. When you look at the wholesale channel, when you look at loan officers who first get exposed to what the broker channel can do, you're no longer limited to just what your company offers. You have a wide array. I mean, you could be working with potentially 200 plus wholesale lenders,
right,
that offer reverse mortgage, non-QM, you name it.
It's almost like a marketplace to find the best option for your borrower. You're not yep.
And that's the key point, right?
Yeah.
What's the best option for your borrower? Mm-hmm. It might not be that FHA loan. It might not be that conventional loan. It might be something else. And so you're able to truly look and work with that consumer, understand their need, their unique situation. Maybe they need a bank statement loan. Maybe they need a second mortgage and their credit score is a 640, which most lenders don't have that product. Mm-hmm. But as a broker, you can go out and find a wholesale lender that's willing to offer that product. And in some cases, it's, there's hard money that can come along with it. And you're able to satisfy that customer's needs with a lot more product in your arsenal.
Yeah.
And get a deal you might not have been able to get with a limited
Exactly.
portfolio of products, which is why
Exactly.
in like a high interest rate market, you see these transitions where we might not be able to give you a better interest rate, but we have a bunch of other products that might be able to provide some benefit, right?
Yeah. You don't have the mass market for the refi.
So when you tie that back over to what your marketing cost per funded loan is, since you're not limited and you can help a lot more customers because you have a wider product set to work with, your marketing cost per funded loan could be $1,500, and because you're able to convert that many more consumers. And then, a lot of the brokers that I work with, yes, the individual loan officers are paying for their own marketing, mm-hmm. which is different mm-hmm. and a risk, right? Are you willing to bet on yourself and spend marketing dollars to generate leads that you need to convert? And so they're spending their own money, but they actually get significantly more of the revenue generated from that loan.
More bips.
And so
yeah.
all in all, they tend to make more money, but you're betting on yourself.
Yeah,
right?
it's
spending
the risk
money.
aversion that might prevent.
Yeah.
Yeah, they have to be willing to commit marketing dollars to their effort instead of just talking to their, their network and things like that, advertise at the golf course or throw a pamphlet out in the neighborhood or whatever.
Right.
They've got to be able to commit some marketing dollars to generate enough inquiries. But then, do those deals typically, would you say, because they're so different and unique, like you may be working with a self-employed borrower, you may be working with someone with a lower credit score, those deals typically can take a little bit longer to fund as well. So maybe, there's that too.
They could. I'd say the pull through rate on those, the deals that you lock and versus those that actually fund, the pull through is significantly higher. The referrals tend to come, quite a bit more. So, there's definitely some benefits, right? And you learn a lot more about the industry through the vast array of products. I got my CMB designation 5 years ago, and I remember for the longest time, 15-ish years, I was I wanted to know more about this industry that's been so good to me. Mm-hmm. And I was looking for a way to become more and more educated. And I finally stumbled across the School of Mortgage Banking that the MBA offers. So I enrolled in courses there that then led into understanding the CMB designation and all that entails. And so ultimately you get a big education on the entire industry, capital markets, servicing, regulations that you normally wouldn't be exposed to. So I think I see, a lot of loan officers who have been in their bubble working in consumer direct, and they just go to another place because, maybe they're spending more on marketing or their commissions are a little bit better. Once you see, what's available in the broker space, you get a big education on all the products that are out there. Now, as much as I'm hyping up the broker space, I will say it's not for everybody. I see plenty of people who go to the broker space and then run back to a place where they're being handed leads, they're being handed transfers at no expense to them, and they the Monday through Friday and
consistency
and so
of it. Yeah,
depends on what's going to work best for you as an individual. But I've seen a lot more so than I probably ever have in my career go from the consumer direct model to the broker space.
Well, and what's really interesting, you mentioned this earlier, a lot of those brokers are trying to have a little bit of a consumer direct focus or a hybrid model. And I do wonder if that's going to be more and more popular as things start to heat up. Being able to have that deliberate corporate sponsored marketing strategy while also the benefits of being a broker and all the product portfolio that's available to you. If you can thread the needle there's just a massive opportunity and massive efficiency that can be driven.
Oh, certainly. For sure. Completely agree.
I think there's a big selling point there too to the consumer experience and, being able to say, no matter what your situation, I'm going to be able to find you a product or solution that is best for you versus let me put you into the product that we have available that is,
and tell you why this product is what you need.
Exactly. Yeah. So, that's interesting. So lots going on there, a lot of shift, I remember, and I think I've talked about, January 2022 is when I kind of sensed the rates were starting to creep up and they were talking about rates increasing. I was like, man, I got to lock my refi before the rates, go up. And I got it in the nick of time. And I was so grateful for that. But it was like about March, I think, when they started to uptick, and they've been in that state now for, it's like going on 40, almost 40 months now of this rate market. There's a lot of pent up demand, and as soon as that the rates can come down a little bit, I've heard something like millions of borrowers that are eligible for a refinance, and it's gonna be a boom.
It's interesting because, and you're right on the timing. We all knew rates were going to be going up. We had no idea rates were going to be going up as much as they did
for as long.
So then the questions started becoming, and the data started coming out of how many borrowers are, quote unquote, locked into low interest rates. And so, a lot of people are in the 3s, some are in the 2s. But when you look at the percentage of people that are sub 4.5, the likelihood that they're going to do a refinance is pretty thin. Now, we've also had a massive increase in equity in home appreciation. And so there's a lot of tappable equity there. And we've seen the rise of home equity products because of it. But we've now been in this higher interest rate environment for a couple of years now, right? So you have all these transactions that have transpired over the last 2.5 years that when rates hopefully do start coming back down, consistently and get into the fives, I wouldn't call it a refi wave. You'll see an increase in refi activity, or maybe it's a mini wave, a baby wave, that if you want to call it that, but you're not going to see such a massive increase in production that we've seen before, right? There's just too many people sub 4.5.
Mm-hmm. Well, there's been a boom, along that same line. There's been a boom in home services and home remodel, as those people are in low rates. So like, I'm going to stay here. It looks like I'm here for a while. Let's make this place, comfortable for us and get that, landscape remodel, get that, kitchen remodel, whatever the case might be. And so that's certainly fueling the economy as well.
Yeah, I think you'll see a bit more age in place.
Yeah.
We have some good friends that are not too far from us. They've grown their family. Their house is too small for them right now, but they have like a 2.75% 30-year fixed.
Can't walk away from it. Yeah.
No, you can't. Right. So, they've drawn up plans. They're going through the permitting process of what do they want to do to, build an addition or a second story, and they're exploring those options. But right. So there's going to be a lot of that.
Yeah. This happened to me recently. We've been working on getting a new home, and the home that we're currently in, like, we've got an interest rate, and I'm like, I just don't want to sell that interest rate. Like, I can't sell it. Like, it's such an asset to have a good interest rate. So I'm like, I got to figure out a way to keep this and at least rent it, because it's crazy when you're doubling your interest rate when you get a new home, and you don't want to sell that amazing interest rate, because it really is such it's like an asset in your portfolio.
Yeah. And as we, even this morning, I was having a conversation with a teacher at my son's school. She's been in her home for 25-ish years. She has a lot of equity. She has, a great interest rate, somewhere in the 3s. And she took out a second mortgage to actually buy another property, and buy another property out of the country. But she didn't want to get rid of that first mortgage interest rate. But I don't know. I don't think her balance is very high, and the rates on the second mortgage are going to be significantly higher. Like, when you think about what your blended rate would actually be, like, maybe it would have been better for her to do a refi cash out. So there's still going to be opportunities like that. There's still going to be opportunities where people need cash and they just mentally don't want a second mortgage. So there'll be, we're still seeing a lot of refi cash outs now in the clients that I'm consulting with, where people are going into higher interest rates for it, and that's what they want. So, there's still some activity, but it's going to be a different dynamic. We get down into the 5s. It's going to be exciting, but it's not going to be a massive flood of refis.
Let's talk about lead generation right now and what's going on and what you've seen and as you've been advising different companies and things on their lead spend and their lead generation strategies. We had this year the almost near rollout of single consent that got pulled back, and we've talked about that a little bit on the pod here as well.
The 11th hour.
Yeah.
All the people who were prepared got punished.
So let's talk about that a little bit.
Yeah, so for context, right? 1-to-1 consent was going to be hitting in January of this year, where if you think about lead generation companies that are selling leads 2, 3, 4, 5 times to different lenders, they were going to have to put on the page checkbox options for, do you consent that these companies can use automated dialing technology to call you and text you? And that was going to greatly disrupt the lead gen ecosystem. And I have one client who, at the time, they had 400 and some loan officers. They're much bigger now. And over 50% of their production was from these lead generators, these lead sellers. And I was saying, you guys have to start generating your own leads. You have to kick up your spend on your own, because you don't know what's going to happen to that entire industry. Some companies are going to go out of business. right? All of a sudden, when consumers that normally they're selling a lead 3 times on average, only sell to 1.5 on average, your price per lead might skyrocket. Convert if you have to pay 3x the price, that doesn't mean you're going to convert 3x higher.
Oh, yeah.
Right. So if all of a sudden you're buying an exclusive lead instead of, buying one of 4 legs of a lead cell, you're not going to see 4x the conversion. So your marketing cost per funded loan is going to jump, and that's not going to work for a lot of lenders. And there's a couple of lenders out there that keep lead generators in business, right? You lose one of them, and I'm sure we all know who we're talking about, but like you lose one of those major lenders, and it's really tough to survive from a lead generation standpoint, from a lead generation company standpoint.
Yeah.
And it was going to dramatically change
I kind of
the
saw,
entire landscape.
Yeah, I mean, it never came to fruition, but I was sort of, predicting that a lot of those costs are going to somehow get pushed back onto the consumer. Consumer's going to end up paying a price. Yeah, it'd have to.
Yeah, where else does it come from?
Yeah.
I mean, I say it would have to, but then you start to think about the other marketing channels.
Yeah.
Right. So that's not going to affect direct mail. It's not going to affect paid search and when you're generating your own leads. So it's going to affect, a lot of people call it that lead aggregator channel.
Yeah.
And so when you think about lenders and where they're going to allocate marketing spend, they would just spend less in that channel because you can't just increase rates for consumers that came in from that channel. You can't do that.
Yeah.
Right. So
you might see just total strategic shifts. Yeah, to your point.
Right. Again, making that entire industry very much disruptive. Now, is the consumer experience, ultimately what they're trying to fix with this one-to-one consent? Sure. Is that the right way to do it? I don't think so.
Yeah.
I think there's other ways that you can improve the customer experience, and the one-to-one consent was going to be a brutal change. I didn't think it was well thought through. But do I think there needs to be change to protect the consumers a little bit more? Yeah. So I'm glad it got pulled out. It's terrible that it got pulled out last minute because I know a lot of companies that spent a ton of money to prepare for it, only to have it taken away last minute. So you think about the procrastinators, and there were plenty of people in early January that I was talking to. And it's like, well, what are you going to do? I don't know. We'll wait and see and then figure it out. It's like, wait and see. This thing's coming in like 3 weeks.
Yeah, like you're out of
business.
Oh
yeah, we'll figure it out later. They got bailed out, being a procrastinator.
At Lead Gen World, they were doing some polling, and half of the people that were polled, this is 3 weeks before it was going to affect, half the people that were polled didn't have a plan. They were expecting it to be maybe, done away with. And I guess that was a good gamble on their part, but interesting. So like knowing that, that is maybe a better consumer experience, and that advertisers can shift their marketing dollars into other funnels. Like, are you seeing that happening with partners today? And, now that it's sort of been, taken off the table, have you seen some shifts in strategy that way?
Yeah, I think, I wouldn't say I've seen it shifted away. I think a lot of people, short-term memory, like it's gone.
Still
like
using
they
the
think
ags.
It's gone and it's not an issue anymore. I believe it's only delayed.
Yeah.
Right. So January 2026, I think, is when it's supposed to go into effect. Now, whether it will or will not, I don't think it will. I think it'll go away. I mean, we've seen a lot of deregulation efforts happen over the last handful of months. Right. And, the CFPB has been neutered. And so, there's been a lot of changes there. So I don't think it's ultimately going to go into effect, but we'll have to see. But I do always think too, right? Like from a marketing perspective, what lenders and brokers, anyone who's spending marketing dollars to try and generate business should be doing is diversifying their marketing mix anyways, right? You shouldn't have all your eggs in one basket. Because what happens if a lead company goes belly up? Right. And there's a lot of, I've been working with a lot of social media influencers in the mortgage space recently. And a lot of their talk over the last handful of months has been like, thank goodness they're not all in on TikTok.
Yeah.
Because we had the potential TikTok ban, right? So if all of your business is generating content on TikTok, if that goes away, even for a month or two, and then comes back because it's haha, just kidding, like you're not banned anymore. Like that's very, very, very impactful and disruptive. So you should always be diversified. Obviously it depends on the budget that you have available to you and what your spend is. But
we always have we have the Google algorithm changes too that take place where all of a sudden the Google algorithm changes and then now your ads aren't being shown and
you're in learning mode again. And resetting.
Right. Yeah. And there is a while back, there was someone that I worked with who, for the term refinance, they were ranked number one organically, and they were crushing it. I mean, they were generating so many leads at hardly any marketing cost. And oh gosh, it's probably going to be wrong, but for some reason, the Panda update, and that's going to date me quite a bit. I think it was like the Panda update or something like that. All of a sudden, kicked them down quite a bit, and overnight, they're ranked 5th, 6th, 8th, or whatever it was, and a lot of their volume evaporated, and so they didn't have a paid strategy in place. So it just goes to show you how we're very much at the mercy of platforms, of strategies. And again, if all your eggs are in one basket, it creates quite a bit of risk to the business.
Yeah. You got to be diversified. You have to have multiple sources and streams of leads for your strategy.
Well, and that's true for any business, I think. I mean, we've talked about this, Carson, but in 2021, we 75 to 80% of our business mortgage. We kind of had the foresight to say it's looking like rates are going to go up. We are not confident that all this business is going to stay at the scale that it is. So how can we diversify, and how can we put ourselves in a position to capitalize on some of those counter-cyclical industries?
Yeah.
Home services, debt, when mortgage rates are high, those are great places to kind of sit, and we were able to do that.
Healthcare,
yeah, things like that, that are totally, I mean, really, healthcare is very insulated from any from a lot of economic,
recession-proof sort of.
Yeah, exactly.
Yeah.
Well, and if you even think about, so I was running the mortgage vertical at Jornaya in 2020, and so COVID hit, rates were being plummeted. Right, they went so far down so fast. We were hearing of lenders, when a consumer called in, they were on hold for 40 minutes before connecting with the loan officer, right? And so it's amazing, right, that was actually happening, and borrowers were actually waiting. But what happened then was there was such a flood of business coming into the lenders that they turned off a lot of their marketing spend, because at that point, any marketing dollar spent is a marketing dollar wasted. You had too many leads coming in organically, or through your email nurturing or something. And at Jornaya, we had a large chunk of our business in mortgage. We also had a large chunk of our business in insurance. We were able to, and we would witness, we had a JavaScript code on all these lead generation websites. You could see how leads being generated through these partners plummeted in mortgage. And in insurance, it started skyrocketing, because a lot of these lead generation companies are in both verticals. Mm-hmm. And as soon as demand started evaporating from the mortgage side, they just spent more of their budget in insurance, and the insurance industry started taking off.
EPC, it's side. Like EPC driven, right? With mailers and things.
You start to see who's diversified and who's able to flip the switch, and it saved a lot of those lead gen businesses for sure. So being diversified is absolutely necessary in whatever capacity. So if you're in the mortgage industry, you're buying leads, don't just buy them from one partner, buy them from a couple. If you can get direct mail going, if you can get some paid social, paid search. I mean, you don't want to be spread too thin, because you need enough data to be able to see what's working and what's not working. But if the budget allows it, you want to be, I'd say, in at least 3 different marketing channels.
Yeah. Yeah, absolutely.
So what are your predictions for the next year? How do you think the industry is going to change when we look back in a year, when we do this again? What do you think the story is going to be in a year?
I mean, we're already seeing the AI story, starting to play out, right? Better has Betsy, which is their agentic AI agent. It's getting better and better. So I'm working with some folks on an AI agent. It is amazing at how fast we hear it all over the place, but it's really true. This technology is advancing so incredibly fast. It's only a matter of time before it's more and more embedded into companies, and it's more and more accessible. So that's, of course, going to be a story in how AI is impacting the industry, whether it's from an underwriting standpoint, marketing, helping with nurturing of conversational texts, and but in a much better way, in a much clearer and concise and educational way. But I also think along with that's going to come the risks where some of these LLMs do not have the guardrails that are needed to protect consumer data. The fact that you're going to have policies and procedures in place to be monitoring, what's actually being said to the consumer. Is it getting into licensed activity or not? So as much as over the next 12, maybe 24 months, we're going to see the rise of AI engaging with consumers, we're bound to see some missteps as well, where there's either consumer data accidentally being given out to the wrong person using AI, or some sort of major misstep. So it'll be interesting to watch and see as that transpires. But yeah, I think, of course, AI is going to be a big movement in the industry.
I think the consumer aversion to using AI is going to be something too. Not everyone wants their loan to be handled by an AI, right? So having the option and the ability to say, hey, no, I want to work with a person that I can talk to, a human.
Yeah. That's going to be dictated by the consumers, their comfort level. How comfortable are consumers going to be interacting with and engaging with and handling their process with an AI agent? And if the consumers at large feel comfortable with that, it's going to probably advance faster. If there's hesitancy there and resistance from the consumers to engage with, 10 years ago it was phone trees, we just hate phone trees. Like, zero, give me the operator. I want to speak with a person, and I want to speak with an agent. I don't want to listen to these, 15 options and press the right button and all that kind of stuff. But, the AI agents are a lot more intuitive, and you can, ask it something, it can kind of understand you and it can direct you. And, so we'll see how consumers interact with and allow that to move forward faster.
It'll shortly be table stakes, I think. Eventually it will be kind of expected that hey, this is how business is done now.
Well, in the early 2000s, there were websites that could accept credit card information. A lot of people didn't trust it and wouldn't put their credit card information. So they would never put their credit card information onto an internet website on the World Wide Web.
Who's going to buy a book online? Who's buying a book online, right? That's Amazon.
Yeah, now we do it every day. Everything we do.
Now I'm like, I need a pencil. Yeah. Amazon, ship me a pencil tomorrow. It shows envelope.
Pay $5 for a pencil.
Yeah, that's exactly right. Yeah, it's gonna be interesting to see. We've definitely seen like the proliferation in all areas of lending, both on the marketing side and the underwriting. The phone trees and the IVRs and the AI agents that try to help you, that still drives me crazy. Sometimes you just want to speak to a person. But
well, actually, we could talk about this. We're testing we have an inbound AI agent that we've developed that can field an inbound call after hours, and it can schedule an appointment for the following day, and it integrates with our dialer to where it'll basically push the consumer into an appointment that fits for their schedule. Mm-hmm. When would you like us to call you back? And it conforms to only allowing them to schedule within business hours. But the big trick with it is if there's any background noise, it glitches out bad. It gets confused if there's somebody talking in the background or any kind of, I mean, it has to be completely silent and it works perfectly. But if anybody says excuse me, it'll interrupt itself and it'll get off track, and then it won't tell you who they are or who they're with, because it already started to say that, but then it got interrupted. So there's a lot of things that need to be fixed on that.
There's required statements it has to hit, but it's interesting.
But it works pretty good. But it's
it's funny because I have 3 young kids, and so walking, I put my hand over my face, it's so stressful. It's, typical parenting stuff, right? But I'm on the phone going through one of those automated agents, and I walk out into the kitchen, and then my 6-year-old's yelling across the house to the 3-year-old, and all of a sudden the agent's, "I'm sorry, I didn't get that. What did you say?" And I'm like, oh my gosh, it's going to start this whole thing over again because it heard my kid in the background, right? So that it can get frustrating. And the great thing is that the technology is coming along very fast, and that's going to be a very publicized and known issue with those types of solutions that, someone's bound to come up. There's probably already a solution out there. It's just not widely available yet, but it's just a matter of an update, or a couple of updates. And the next thing you know, it's talking right through the noise. There's, whether you're in a restaurant or something like that, and it'll know it's talking to you. So it's just a matter of time.
It has to listen, and it'll pick up your voice and know your voice versus a voice in the background. Maybe that's probably the solution, right? But
well, it's amazing. I mean, the agent that we've built, the appointments that it schedules, so it's just off hours. It's all incremental. So when our reps are not available, it goes to an AI agent. Hey, this is, I think it's Allie, your AI agent or something like that. And 35 to 40% of those appointments that it schedules turn into a sales qualified opportunity for our partners, which is all incremental. It's
absolutely
on top of everything
and
else.
Those are, equate the after hours one, when people are available, they could be at a job where they cannot pick up the phone and they're working, an 8 to 5 or something. And then they come home and it's dinner time. And then now you're talking about after hours, and they call in because that's when they can handle something. Mm-hmm. And then they're able to schedule an appointment that works for them. That's a unique opportunity for that particular, in our case, lender, let's say, where they now know when the person's going to be available, when anyone else competing to get a hold of that consumer doesn't know when they're going to be available, and they're very hard to get a hold of. You're going to have a very high conversion rate on that. It's the same thing when loan officers work on a Sunday. It's, for a lot of consumers, that doesn't work. There's church, there's sports, but for the consumers who are home and willing to talk on a Sunday and that loan officer is working, you have this protected moat around this consumer because most of the other lenders that are chasing after this consumer are closed on Sunday. So
10 o'clock on Thursday night, or something.
Yeah, it's true. And this really is an extension of 5-10 years ago, omni-channel was all the talk. It was everything. Communicate with the customer at the time and in the way that the customer wants to communicate. And now that's table stakes. It was not 5-10 years ago. But now that's the expectation. If I want to talk to you now through text, you need to have a way to figure that out, to communicate with me. And if you don't, I'll go somewhere else that does. That's how this is going to be. This is just kind of the next step of that. And who knows what that will be in 10 years,
It's coming. It's here.
Yeah.
We're gonna optimize it, and I think those that leverage it are going to be way more successful and embrace it. Those that resist are going to, kind of, be left in the dust a little bit. So
absolutely. Well, this has been awesome. We've covered a ton of great material, and we've really enjoyed this. Thank you so much for hopping on with us and kind of opening up your wealth of knowledge. I think that. It's been a great conversation. We really appreciate it. We also appreciate your partnership with us and the the relationship that you've had with our company and with us. We really appreciate it.
Yeah, it's been a long relationship. Like you said, it's going back 10-ish years, and you guys have always been fantastic, and it's been a pleasure. And you can tell you guys really care, right? When there's ups and there's downs on both sides, and you guys are always very empathetic through those and have been fantastic partners. So, I'm glad we were able to do this. Thanks for having me on. And it's always great to catch up with you both.
Yeah, thanks so much, Mike. It's been great to catch up with you, and always great to hear what you're working on and doing, and excited to see your path forward and everything you have going on here in the near future. So I know we'll catch up with you again here soon. Thanks so much for being with us.
Thank you.
You've been watching the Juice Consumer Direct podcast. Thanks so much for watching. Make sure you like, subscribe, give us a follow.
Yeah, leave us your questions, your comments below. If you want to find Mike, where can they find you?
LinkedIn as usual, or Mike at nextpercent.com. Feel free to reach out.
Okay, perfect. Thanks.
Thanks, Mike.